Good afternoon, everyone. My name is Brian Overby. I'm the Senior Options Strategist at Options Play, and today our presentation is titled The Essential Option Concepts, basically understanding what calls and puts are. This entire presentation is going to take about 45 minutes when we'll open it up for questions at that point in time, but I will take questions along the way. If you do see the Q&A box in your tools available to you, do click on that and have it open. We'll be addressing any questions as they come in, but we'll hold off a lot of them until the very end of the show. So here we go. Before we get too far along, we have to talk about a little bit of disclaimers. Options Play. Everything that we show you today, including real life examples, are not meant to be recommendations. Just want to make sure that you know that. And if you are a client of First Trade and you want to trade options, you should read the characteristics and risks of standardized options. It's all available to you throughout the First Trade website, but if you'd like a copy of it, you can ask them for it. And realize that if you are trading options, there are risks that are involved with each and every trade, and you could lose your entire investment. So keep that in mind whenever you're considering doing option trades. All right. The agenda, we're going to do a review of the basics of puts and calls. We're going to look at an options chain. We're going to specifically, I've decided I'm going to actually pull up the options chain inside the First Trade platform, and we'll talk about buying long calls, and we'll talk about buying long puts. And we're going to put it all together, and then we're going to come back and do a little Q&A on that session. So let's begin. What is an option? An option is a contract. Now, when I look at options and think about it from way back when in the day, a lot of people take a different view on what options really are. Before listed exchanges, there was an actual contract that was written up about options, and it's a contract between a buyer and a seller. And there are a lot of similarities between an options contract, especially when you think about it in the olden days before the exchanges were in existence, and an actual contract for an insurance company. So if you think about the fact that somebody actually if you buy car insurance, somebody actually writes a policy, you sign the dotted line, you pay cash, they have an obligation. If you drive your car into a tree, they're obliged to give you a new car. And that is the way an insurance contract works. There's a lot of similarities in the options trading world. So I always like to think of that options, first of all, weren't intended to be speculation. You can leverage your position and you can speculate using calls and using puts, but that's not what they were first intended to do. They were first intended to provide some protection, and a lot of them were on crops, on the commodities across the boards. And then they eventually, in 1973, the Chicago Board of Option Exchange opened up its trading floor, which actually used to be the old smokers lounge of the Chicago Board of Option Exchange. I used to work there, and I used not in 1973, but I did used to work at the Chicago Board of Option Exchange, and that was the first trading floor for option trading. So here's what it is. It's a contract between a buyer and a seller. Buyers pay a premium and they can execute on the rights embedded inside an option contract. The sellers collect the premium, and hence the term premium, right? And then they take on an obligation to fulfill the terms of the contract. It's issued as a call or a put. The call contains the right to buy, and the put contains the right to sell. Don't know where the sell part of it went to, but the term premium is once again taken directly from the insurance world. When you pay for an option contract, the buyer pays what is called the premium. That is the quote. It is an actual contract, but now whenever you get a quote on an option contract, it's a truncated version of that contract. And they're just highlighting the major points that are inside the contract, i.e. the expiration date, the name of the underlying company, the potential strike price that you might buy that underlying act, the fact that it is 100 shares. All of this is embedded inside an options quote every time you look at an options contract. So the anatomy of an option. What are we agreeing on? What are the product that we are agreeing on, right? So once again, it's a negotiated contract, much like your car insurance. If you are buying car insurance, what is the car? Is it going to be a Chevy Cavalier, or is it going to be a Bentley? There's a little bit of difference in price. There's going to be a little bit difference in cost. And then once we figure that out, we're going to actually go in and look at the price. What is the premium that you're willing to pay for that option contract? And what is the time frame? Time is money. The further you go out in time, the more costly the option contract is going to be, much the same as an insurance product. So you got the contract amount. Every contract represents about 100, well, it's not about 100 shares. Now, there are some situations that may make an option contract not be worth 100 shares. But in general, this is very important to know that if you are trading options, the basis, every option contract that starts, that is initiated in the options trading world, will equal 100 shares. Now, mergers and acquisitions happen, stock splits happen, and because of that, sometimes they change what the contract represents. But we'll say 95% of the time, if you look at a quote on an option contract, that contract's going to represent 100 shares of stock. Now, in this instance, we're also looking at, we call it the underlying security. I'm only going to really focus on stock options today, so I'm going to assume that, but obviously options can be traded on many different things. They can be traded on futures, they can be traded on stocks, they can be traded on ETFs, exchange traded funds, they can be traded on indexes like the S&P 500 index. The underlying security is what the contract represents, and that is the terminology or vernacular that is used in the options marketplace. So stock, ETP, which is actually exchange traded product, otherwise known, the most popular ones are exchange traded funds, indexes, commodities. What are the price we are agreeing on? That is the strike price. So if the stock's trading at 100, are we talking about the 105 strike, or are we talking about the 95 strike? This is the agreed upon price that if a transaction happens, that the stock will change hands. Either you'll be buying it if you're the owner of a call option, or you'd be selling it if you are the owner of a put option. The person on the other side, the writer of the contract, and that's the first time I've used that word, so I'll introduce it, is also known as the seller. So once again, we go back to the insurance world. Why do they call the seller of an option contract sometimes referred to as the writer? Well, if you buy insurance, you talk to an agent, and then they say, let me send it off to the underwriter. The underwriter then writes up the policy and determines how much your premium is going to be for your car insurance. So in that instance, you have a writer of the contract, and that's basically whoever sells that contract is considered the writer of the contract, and it's much like an underwriter of an insurance policy. So that's where that term comes from. End time frame, as we said, there's many different expiration. Normally options expire on Fridays, but over the last, gosh, I guess it's been 5 or 6 years now, we've gone so far as that we actually have daily, or referred to as zero DTE options contracts that expire at the end of the day, every day of the week. Those are mainly on indexes. Normally, if you're looking at stocks, it's every Friday on very popular underlying stocks. And sometimes the old days, the rules were that options would expire on the third Friday of the month. And that was the rule for a long, long, long time. So those are actually considered, a lot of people will refer to them as the normal option contracts. They'll refer to them as the standard option contract, right? And then they call the other option contracts usually weeklies, and they go out much more than a week, but that's what they started as, right? you had option contracts that would expire on this coming up Friday, and then a new option contract would open up that expired on the next Friday. Now they have mini Fridays, usually all over a month. So there's bottom line is as computing power increased and memory increased and speed increased, that made the exchanges have the ability to offer up more products and more expirations. Bottom line is they had a quoting issue. Up until that time, every time a stock ticks, like if we're talking about Apple, which we're going to look at today, Apple is one of the most popular underlyings to trade options on. Every time that stock moves a dime, uh, uh, gosh, in Apple, there's probably 1,000 different options that are available, and all of those option contract quotes have to move. And because of that, it was very taxing on the Chicago Board Option Exchange to get those quotes out, just because of the dynamics of it. So the fact that computing power increased, that allowed them to offer up many more different expirations. And now we have weeklies and we have dailies, or zero DTE is a better way to say it, because that's the vogue way of saying it. So here's how a contract works. All right. We're going to look at one contract on ABC. We're going to have a strike price of 100, and we're going to go out 36 days. So in this instance, call option is the right to buy, a put option is the right to sell. So we have to decide what we're going to look at. We're going to start by looking at calls. They're just easier. So I've been teaching options for well over 20 years. And when people ask questions about puts, they struggle wording it right. And here's the reason why, is because if you buy a put, you have the right to sell. So I bought that put, so I ended up buying the stock. No, you didn't. You ended up selling the stock. Oh, yeah, I'm right. Calls make sense. You buy a call, you have the right to buy. Now, bottom line is, if I buy a call, I'm bullish. If I buy a put, I have the right to sell, so that means I'm bearish. I want the market to go down. So if I'm an outright buyer of a call, I'm bullish. If I'm an outright buyer of a put, I'm bearish. That's as simple as it gets, right? That's the simplest way you can say it. So exercise or expire or trade. There are three different things that you can do with an option contract. And this is, a lot of people struggle with the concept that you can trade your option contract at any point in time. A lot of people think that if you buy an option contract and it is in the money, that you need to exercise that contract in order to make money on that option. But that's simply not the case. If I am buying an option contract, that just means that I am in control. I pay money. For that money, I get that right. So I can go out and either exercise, and if it's a call option, I'm buying. If it's a put option, I'm selling. Or I can actually trade it. And this is what the Chicago Board Option Exchange and the Smokers Lounge, where they first started trading options, provided. They provided a marketplace in order to, you could buy this option contract and then you could go out and sell a different option contract. Now, I wrote the chapter for the book, Essential Option Strategies, at the Chicago Board Option Exchange, and inside the book, I had access to the library from the Chicago. They did actually have a library at the Chicago Board Option Exchange. And there is a book that would actually show real contracts that were written up prior to the exchange. And it was a contract, and it actually was the start of the quote pages in the newspaper. Remember, there used to be quote pages way back. I can remember them. I'm old enough to be able to remember them. But that where there would be an advertisement saying, I have this option contract with this strike, with this expiration. If you want to buy it, give me a call. And back then, there were obviously very illiquid option contracts, so most of them were either exercised or assigned, right? So if you got exercised and you were the buyer, that means you were in control. Then that meant somebody got assigned on the other side of the trade, or they expired worthless. And that's not a good thing if you're the buyer. That's a good thing if you're the seller. All right. Sorry about that. And so then once this is determined, everything happens and you pay a premium, and then you own that option contract, and then it's in your account. So here's the four basic positions that you can do. We're going to focus on buying today. We're going to talk about buying. If you buy a call option, you are considered long that option in your account. So here's how the vernacular works. I buy the call, I get the right to buy that underlying stock. Once I have bought that stock, I'm considered long that option contract. Not sure why it's long, but that is always the way it's been referenced, and you can reference that with a stock. But in the options, it's very important to get straight that if you are long or short, or you're the seller of the option contract, because it's very easy in the options world to sell an option without owning it. A little bit tougher in the stock trading world than in the options world. But in this instance, if we buy the call, we have the right to buy, we have the put, we have the right to sell, then it makes sense. The seller has the obligation to do the opposite. If you are the seller, once you say, I am selling this option contract and I have sold it, I am then considered short that option contract in my account. And I take on an obligation to sell on the call side of things, and I take on an obligation to buy on the put side of things. So selling puts, some people, think about this as unlimited risk, but one of the things about selling a put is you're just saying, if the stock comes down to my strike, I'm willing to buy it. So it's a very popular strategy. If you were thinking about buying the stock via a limit order, to say, I'm going to look at this call option, figure out the price that I wouldn't mind buying it at, and I'm going to sell that option contract, saying I'm willing to buy the stock at a lower price, and you actually get premium, you get cash now for saying you're willing to buy the stock later. So even though it is considered advanced, in many ways it's a very basic strategy if you want to buy options outright, if you want to buy stocks outright. All right. So this is a good old school XYZ example of a call option. And this is a contract. So when you look at a quote, you should think to yourself, this is an actual contract that I may have, quote unquote, in the olden days, negotiated, right? We got stock XYZ. Now, XYZ is actually a symbol now, but you see so many generic examples. It's really sad that they actually turned it into a symbol, but it's a stock. It usually represents 100 shares, and this is inside the quote. Then you see an expiration date. That's the date the option expires, the last day to trade. It's usually the third Friday of the month, but nowadays we talked a lot about the weeklies and the 0 DTEs. And then we have a strike price. So the strike price is 70. That's where this XYZ 100 shares of stock would trade hands. And then in our instance, we're showing a call. That means you have the right, and this is actually where the term call comes from. You have the right to call stock away from somebody as opposed to the right to put stock to somebody. So that is actually the term. That's where call comes from. I'm calling the stock away from you. And that's the type of option. So you got the two different flavors are calls and puts. And then lastly, you have the premium. Now, we emphasize here that most of them represent 100 shares. So when you see a quote, you have to multiply it by the number of shares that it represents. So if we see that price is $3.10, if you want to buy that option contract, it's going to be $310 plus any fees to purchase this 70 strike call that expires on December 17th. All right. Now, this is a little bit of an older chain, and I'm going to pull this up, but I'm using a slide that Tony Zhang, our chief options strategist, put together, and did a really good job of just highlighting fields inside the first trade platform. But this is Apple. So Apple at the time was at 189. And when you pull up an option chain, first of all, you see all the different expirations across the top of the chain. The expiration that you want to choose, you want to highlight in that instance. And then you see all the different expirations available. And then I have something called Leaps options. Now, Leaps is just a marketing term, and don't let that term scare you. I was on the Chicago Board, I was working at the Chicago Board Option Exchange when they decided to add Leaps. And all they are option contracts that go out over 9 months in time. And it actually is an acronym. It stands for Long-Term Equity Anticipation Securities. So it's a stretch, but that's where Leaps comes from. So if you actually say, I want to buy a leap option. You're actually using the term wrong. It's a leaps option because it's an acronym. It's not an actual word. And, you know, a little bit beyond, above and beyond. So once again, we're looking at we got calls and we got puts. So on this side we have calls, on this side we have puts. Here's our strike prices that are available. And First Trade does a really good job of highlighting option contracts that are considered in the money. Like on the call side of things, that means that you have the right to buy it at a lower price than where it's currently trading. So in this instance, the 180 call is $9.81 in the money. That has intrinsic real value, and it's highlighted here by being highlighted with a yellow color in this instance. Bid ask is the bid price is $9.80 if you're selling. It's $10 if you're buying. So here's your bid ask on your trade, and that means that this represents 100 shares. So if I were to buy this call option, I'd take 10 and I'd multiply it by 100, and it would cost me $1,000 to buy this call option with the right to buy the stock at 180, even though it's trading at 189.80 right now. So it has to trade for at least the in the money amount, the cost of that option contract. Now, the most popular contract is usually right where the stock is at, the 190 strike call. And here we're seeing, once again, we have the bid, we have the ask, and it's a lot cheaper. Why? Because you have the right to buy the stock at 190 instead of 180 in this instance. And then if you want to speculate and you want to buy cheaper option contracts, you can buy the 195, and that's inexpensive, but there's only 1 day remaining to this expiration date, which I should have highlighted, by the way. This is the February 9th expiration. It's considered a weekly. There's 1 day remaining to this option contract. And so it's inexpensive. Why? Because there's a low chance that the underlying stock is going to get to 195 by the end of the day on February 9th when this is all put together. All right. Now, if you have any questions, please do put them in the chat box and we'll try to address them. So now if I jump over to the leap side of things, we're still in that same expiration, so you want to highlight that. But you'll notice that the highlighting of the options now, these option contracts are in the money because you want the market to go down. So with puts, you always got to kind of think of them backwards. How do I determine if they're in the money option contracts? So you got to think, well, what if I bought the stock and then exercised? So if I bought the stock here at 189.81 on the marketplace and exercised, I would want to sell it at 200 as opposed to 180, right? So if I bought the stock and then exercised, where would I be selling the stock? As opposed to the call side of things, if I exercised and bought the stock, then went and sold it, how much would I get in that situation? And that's a totally different scenario as far as that is concerned from beginning to end. All right, so we have calls, we have puts, we have different expiration dates, we have different strike prices. This is the beauty of an option chain. And now you can understand why the exchanges needed computing power to add weekly options or daily options. All right. There's the strike price. I guess I already highlighted the strike price. We're going to let that go. But this is a big one here, that it's really nice that you can bring up all the expirations and then highlight the expiration dates that you want to see. And you can just scroll through those expiration dates if you would like. Now, in the options trading world, I do need to highlight this. The last is not as important as a lot of people look at it or perceive it to be as far as the stock is concerned. When you look at the last trade of the stock, it's very liquid. It's like if you're talking especially about Apple, it's trading every second of every day. With that said, the last trade of the stock is fairly important. But in the options trading world, they don't trade nonstop, not every option contract. So sometimes in an instance, let's see if we can find one. Let's look over here. Last trade. That's outside of the bid and ask. Well, this one is right here. So the 197.50 put, the last trade was $8.02. But you see the market is 775 by 795. So the last trade might have occurred an hour ago. And it is now at a much different price, and the bid ask has become a lot tighter than when that trade went off. So be aware that the bid and ask is really the most important thing when you're looking at a quote on an option contract. The bid is the sell price if you were to sell that option, and the ask is the buy price if you were to buy that option. Now, the markets are a little bit wider than they're going to be on the stock, and that's mainly because there's so many options that are available. But usually on the most popular option contracts, you get very tight markets like we're seeing, especially on a stock like Apple. You see the near term at the money option contracts have a very tight bid-ask spread. That means that it's not that wide. In if you bought and sold right now, you wouldn't have a lot of exposure on a stock like Apple to the difference between the bid and ask. That's called liquidity. That's another word for it. And I guess I'm highlighting it. I'm talking about them, but I should be highlighting them. You have volume and open interest. Now, these are two terms that are very important in the options trading world, and we're going to get into these. But an option's a contract. So because it's a contract, if nobody trades it, does it really exist? Right? You can quote it all you want, but if nobody actually buys the option really doesn't exist because no contracts were written. You never had somebody sell that option contract to somebody, and because of that, there wouldn't be any open interest on the options. So open interest is the number of contracts that were written and bought by somebody else. So volume very rarely goes along with open interest. And you want open interest. If you are going to be trading an option contract, most of the open interest is usually on the option, the most liquid options that are very close to where the stock is at. And if you have open interest, you literally have more people interested in the options contract because there are more contracts that were written. Open interest does not move during the day. Volume does. Volume is, and what determines open interest is how the volume is marked. If you're going to enter an order for an option contract and it's your first time buying it, you say, I'm going to buy to open the position. When you go to sell that option contract, you mark your ticket as, I'm selling to close that position. Why is that important? Because you could sell it to open very easily, right? And the market wants to know, are you opening or closing? Because if volume goes up, it's very possible that volume, and here it is right here, volume is higher than the open interest. Well, how can that be possible? Well, that means tomorrow the open interest is probably going to increase because there were more contracts that were open than closed. So in this instance, they're tracking how the tickets are marked to determine the open interest. So a lot of times you will see more volume than open interest that is out there. So it's a different marketplace than the underlying stock. That simple. Any questions on that? We're going to go into a little bit more detail on it, but here's the important thing to note, that if you are buying an option contract or you are selling an option contract, there are three different things that you can do. And we talked a little bit about it on a slide earlier, but you can close the position, you can let it expire worthless, or you can, if it's in the money at expiration, you can decide if you want to buy or sell the stock, depending on if you're long a put or long a call. And it says, what is DNE, do not exercise? We'll talk a little bit more about that. Michael asks a good question. Does options play have a methodology to evaluate the best expiration date to choose for an option seller? Yeah, that is part of the Options Wizard platform that I'll highlight here in just a little bit inside the First Trade platform once I get over there. So yeah, there is that does help. And normally when we're selling short spreads or different spreads, we're usually looking at going out about 45 days, but you're always aware of when an earnings report is happening too. Okay. So do not exercise. I don't know if I even want to get into that, but basically if you buy an option contract and you ride it all the way to expiration, uh, and it's 1 cent or 2 cent in the money, you can put in a do not exercise and say, I do not want to exercise and buy the stock to capture that 1 cent. And that's a little bit more of an advanced term. It doesn't happen that often. Bottom line is most people close out the positions. And here's the way the number breaks down. Only 10% of options are exercised. And this is usually surprising to beginning option traders because they're like, well, I'm buying this because I want to buy the stock. No, you're buying it because you don't want to pay all the money to buy the stock, right? Options are a lot cheaper. If you exercise and it's a call option, you have to buy the stock. It means you're buying 100 shares at that strike price, and you have to have the money to be able to do that. So only 10% of all option contracts are exercised. Most of the option contracts are sold. 70% of the time, I'm trying to get my mouse to bounce up. 70% of the time, they're closed. So I bought to open, I sold to close. I sold to open, I bought to close. That's what happens most of the time. And then 20% of the time, options actually expire worthless. This is a good thing if you sold it, but a bad thing if you bought it. So here's one of the biggest common misunderstandings. A lot of people say 80% of all option contracts expire worthless. And that's just a general statement. And that's not even plausible, because if you think about it, there are puts and calls. So if the call option isn't in the money, a put option would be in the money. So just in general, if open interest is the same on both of those contracts, well, one of them is going to be exercised or closed out in the marketplace. But that concept just doesn't hold water. So keep that in mind. Keep that in mind, that if you're selling option contracts, the misnomer that 80% of option contracts expire worthless is just really not the case. It's just that straightforward. Most options are traded out of. You buy a call option, the market goes up, I sell it, I take my capital, and I move on. I don't exercise because I don't want to have to spend all the money. That's part of the reason why I bought the option, is I didn't want to put up all the money to actually buy the stock outright. I was just, quote unquote, renting the ability to buy it, if you will. And, so when I'm doing this, this has a lot to do with the open interest number and the concept that options aren't hot potatoes. And I think that's my next slide. And the reason why is some people think of an option contract that it's got to land in somebody's hand. And this is where the 80% of all option contracts expire worthless. That's where I don't even know why that's the number, but that's something that I've heard quoted many times over my many years of trading options. They think that if I have this contract, it's got to go to somebody's hand and they got to end up with it at the end, and then it's going to expire worthless. And that's simply not the case. Open interest is the number of contracts that exist for a particular. High open interest means more interest, and it's you want open interest. You like open interest if you're trading options. So if I'm looking at a strike and I see, let's just say we got 1 point strikes, and our example on Apple was 189. So you got the 189 or the 185. If the 185 strike had more open interest, I might buy that option as opposed to doing the 189, mainly because I want more open interest. It might be a little bit more feasible if I say 185 versus 186, something like that. But open interest can actually help you get fills at decent prices on your option contract. It's not always, it's not a one-to-one situation, but it can help in that scenario. So I'll leave it there. At the end of the day, open interest does not change during the day. It looks at how many tickets are marked to open, how many tickets are marked to close inside the volume, and then it comes up with the open interest the very next day. And that's how that number is determined. All right, so now let's just talk about long calls and long puts. Now, quite simply, if I buy a call and we got XYZ stock expiring in March, it's 36 days away, at a strike price of 150, and I pay $7 for it. So that's an expensive option contract in the option trading world, but that gives me the right to buy the stock at 150. If I do that, I need the stock to get to 150 plus the premium paid, or 157 to break even. but I have limited and known risk on the downside of $7. So my max risk is the max loss occurs when the stock is at or below the strike price from 150 on down. Break even occurs at expiration, and it's important to say that at the expiration date on March 15th, you need the stock to be at least at 157. You need to get that premium in order, you need the stock to at least replace that. And then the max gain is unlimited. Just like if you own the stock outright, you have unlimited upside because you have the right to buy 100 shares of stock at 150. And if the stock continues on up anywhere above and beyond, it goes to 200, 250, you can participate in all that gain all the way up until that March 15th date. And if you want to continue, you can exercise and actually buy the stock at that price if you have the capital to own it. All right. Now, on short equity calls, now if I sold this, everything else is true. Now, being short a call option is a very risky trade, and a lot of retail traders don't usually, or retail brokerage firms, you have to get special approval to be able to do it. But if I'm selling XYZ call March 5th for 150 for $7, we flipped the script, right? Now losses begin from 157 on up. You have unlimited, well, substantially you say, because stock can only go to zero, but your potential gain is limited to that $7, and your break even is still at 157 in this instance. All right. Now we're going to look at puts. I'm not going to run through this scenario here. Let's go down and look at puts real quickly. And then I'll show you some things inside the option chain. Let me pause for a second, take a little sip of my drink. Okay, so if I buy a put now on XYZ, we're going to use that same expiration. We have the right here in this instance to sell the stock at 150. If you're selling the stock, if you're buying the right to sell, means you want the underlying market to go down. It would be 150 minus that $7. 143 is our break even. You have substantial profit potential. Obviously, if the stock continues on down, it can only go down to zero. So we say substantial as opposed to unlimited. But with this instance, if the stock is trading at, let's say, 140, I can take the stock at 140 and buy 100 shares, and then exercise my put and sell it at 150. Hence, you would make $10. You would be able to capture $10, and you paid $7 for the trade. You would be up $3 on that trade. Here's our max risk at 150 or higher. It's going to be the premium paid, the $7. Break even is 143. Below 143, we are profitable. And then if we look at the put side of things, now here's where the put comes in, and I like to sell puts on stocks that I'm willing to buy, but you're flipping the script. Once again, stock's at 150. If the stock goes above and beyond, you receive $7. So if it goes up, you get that $7. You keep it. Stock comes down, you can be put the stock at 150. You don't own it, but somebody could exercise and put the stock, meaning you have to buy. So they're putting the stock to you, means you have to buy the stock at 150. And then from that point on, you're a stock owner, and you have unlimited upside potential. If it's below 143 by that expiration date, you can lose. But it's not much different than just owning the stock outright. If the stock goes down after you buy it, you can lose everything to the downside. So it's very similar to owning stock. But when you initially start, if I do this, I capture the premium, I get that premium, and I can keep that no longer, even if they put the stock to me. So selling puts is a different beast than selling calls, and it's okay, in my opinion, to sell a put on a stock if you are willing to buy it and you would be willing to purchase 100 shares at that strike price. All right, so let's go into the first trade, option chains. And Michael, you came up with questions about expirations and when, does options play offer that? And the answer is yes. Here's the credit spread report, and it's in particular, we talked about short puts. So if you click on this, this will give you stocks and will show you where the implied volatilities are at and allow you to trade these positions and give you recommendations on dates and premiums and time. Now, we've done many webinars. Tony Zhang, the chief option strategist, much more than me, but addressing when you're looking at credit spreads, selling spreads, how to use the first trade options wizard to come up with trades on underlyings that you might want to trade. So, for example, if I click on this right here, I can actually get to the options wizard. And on this side of the platform, if you click on high implied volatilities, it talks about selling short put spreads and talks about selling short call spreads. And we'll toss Apple in here and take a peek at it. And I'll click on high implied volatility. And these are the recommendations on the trades. They're going to default to somewhere around 45 days out, but let's do a bullish put trade. Right, 44 days, showing you the width between the strikes, the strike that you might want to pick, the maximum premium, even highlights here that there is no earnings. The earnings is out till this level. So yeah, that's available to you. But that's a little bit beyond the scope today. So let's go and look at the option chain, and we'll stay in the Apple trade. Okay, so everything that we talked about is here, and I'm just going to click through it and I'm just going to highlight it, and we'll address any questions that you may have. If you have them, please do put them in. We're right at the 45-minute level, and I'm happy to address any questions that you may have. Let's try to keep them a little bit more on the basic side of things if we can, and we'll do that. But make sure you put it in the Q&A box, if you will. So here's Apple. Apple now is trading at 279.52. We have all the different expirations that are available. It says all plus leaps. So all these expirations are across the top here. We're looking at option contracts that are near the money. It's a very, generic term, but that just basically means that we don't have a lot of strikes. But if we want more strikes, we could do all. We could go in the money. We could go out of the money. So in this instance, I'll click in the money. And then this will show you all the strikes that are in the money on that option contract. Or obviously you could go out of the money. Click that and hit go. And now it's showing you all the strikes that are out of the money. And it's basically showing you things that are not in the highlighting thing. So now we can go back in and we can click all. And you just see all the strikes within that specific expiration. Now in Apple, there's going to be a lot of strikes because it's a very popular underlying stock. So most of the time you would keep it at near the money. And a very popular option contract to start with would probably be going out about 30 days. So we're going to scroll this way to be able to look at those different expirations and strikes that are available. And let's do the March 20th. That's 36 days out. We got the near the money, we got the calls and puts, and actually we do have a lot of different chains that are available on the more advanced type trades, but you can do a long straddle, you can do a vertical call spread, a vertical put spread. These are the trades that we were kind of highlighting inside the options wizard, but most of the time you're going to hang out in the call and put chain. That's where I'd spend most of my time, I guess. And if I want to buy an option contract that allows me to buy Apple right at the money to 279.87, so we look at the 280 strike, I just click on this option contract. We got the bid and we got the ask, right? Up at the top, we got the bid and we got the ask. And we're looking at the March expiration. Close that out here. Oops, I'm sorry. Didn't want to do that. March expiration, 36 days away. And I click here. And that puts that down. And here's our trade ticket down at the bottom of the screen. And you would select, I want to buy to open. You got to say open. Number of contracts that you want to buy, that would represent 100 shares. Apple, here's the expiration date, here's the strike price, and here's the type, which is the call, and you'd hit preview order, and if you had capital, you could send that order to the trading floor. And that's that simple, that straightforward. You want to do it on the put side of things? Let's look at over here. We hit the ask price here, then everything happens down here, and you see that here's the expiration date, here's the strike, here's the price, and here's the limit. Whenever I'm doing an order on an option, very rarely are you going to put it in at the market. So we should talk a little bit about that. Even though if you send this to the floor, the price is $7.90, but you'll notice that with most brokerage firms, and in particular with First Trade, if the price says $70.90, usually they will default to a limit order. They don't default to a market order. And whenever you're talking about a 10-point wide bid-ask spread, it always behooves you when the markets are open to put in a limit order saying this is the maximum that I'd want to pay. You can try to fill it at a different price. You could try to come in at $7.85 and get right in the middle there if you would like. That's possible. But that is, most people that are trading option contracts are going to send it at a limit order down to the trading floor. All right, that's the way the option chains work, and that's the way in general the First Trade platform works. So let me get back to my presentation, and I'm going to get down to the end here. And if you have any questions, I'm happy to answer them. I don't see anything in the Q&A box. This was a very, very basic presentation. I hope it reached a lot of the crowd because I didn't get a ton of answers in it. But my name is, or a ton of questions, and usually with the First Trade presentations, we do get a lot of questions. But my name is Brian Overby on X.com. I'm at Brian Overby. Our website's optionsplay.com. We got the Options Wizard, and my book is called The Options Playbook. So I'm going to give you one last shout out, chance to answer questions. And if not, well, thank you for coming, and we'll be back shortly in another couple of weeks to talk a little bit more about the actual strategies in the options trading world. And with that said, so my only hope for you would be that if you are buying options, that they always finish in the money, and if you're selling options, they always finish out. Thanks for coming.